Preparing for a credit analyst at Bank of America interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. How would you assess the creditworthiness of a corporate borrower? I assess creditworthiness by asking one core question. Can this borrower repay under normal and stressed conditions? I start with industry position and revenue stability, then analyze margins, cash flow, leverage, liquidity, and debt service coverage. I also review management, ownership, collateral, covenant headroom, and refinancing risk. At Bank of America, I would link that analysis to risk appetite and responsible growth, not just whether the deal can be booked. While answering, focus on the full credit framework, business model, industry risk, management quality, financial trends, cash flow, leverage, liquidity, collateral, covenants, and downside repayment capacity. Question 2. Walk me through how the three financial statements connect and why that matters for credit analysis. The income statement shows profitability, but credit analysis depends on whether profit becomes cash. Net income flows into retained earnings on the balance sheet. Then, the cash flow statement adjusts for depreciation, working capital, CapEx, and financing activity. If sales grow but receivables and inventory absorb cash, liquidity can weaken despite higher earnings. For a lender, the cash flow statement often becomes the bridge from accounting performance to repayment capacity. Make sure to cover how net income flows into retained earnings. Non-cash items affect cash flow, working capital ties statements together, and why lenders care about cash conversion rather than accounting profit. Question 3. Why do credit analysts use EBITDA, and what are its limitations? EBITDA is useful because it strips out financing, taxes, and non-cash depreciation, so it helps compare borrowers across capital structures. But it is not cash flow. It ignores working capital, CapEx, cash taxes, restructuring costs, and sometimes aggressive add-backs. I would use EBITDA for leverage and covenant benchmarks, then convert it to free cash flow to test repayment. A company with strong EBITDA but heavy CapEx may still be a weak credit. In your answer, talk about EBITDA as a proxy, its weaknesses, required adjustments, and why credit analysts reconcile EBITDA to free cash flow before sizing debt or judging covenant compliance. Question 4. How would you interpret a borrower with 4.0 times debt-to-EBITDA leverage? A 4.0 times debt-to-EBITDA ratio means total debt equals 4 years of EBITDA, before considering interest, CapEx, taxes, or growth needs. Whether that is high depends on the sector. A regulated utility may support more leverage than a cyclical retailer. I would look at EBITDA durability, free cash flow, liquidity, maturities, and covenant headroom. I also prefer to understand debt reduction capacity, because deleveraging is what improves the lender's risk over time. Be sure to mention gross versus net leverage, EBITDA quality, industry norms, cyclicality, sponsor behavior, maturity profile, and why a ratio is only meaningful when paired with cash flow stability. Question 5. What is debt service coverage ratio, and how would you use it in underwriting? Debt service coverage measures how comfortably a borrower can meet scheduled principal and interest. If annual cash flow available for debt service is $12 million and required payments are $8 million, DSCR is 1.5 times. I would design the numerator carefully, usually EBITDA less taxes, maintenance CapEx, and working capital needs. A thin DSCR gives little margin for error, so I would stress revenue, margin, and rate assumptions before relying on it. While answering, focus on how DSCR measures cash available for required debt payments, what numerator and denominator you would use, and how minimum thresholds vary by borrower risk and industry. Question 6. How does working capital affect a borrower's credit profile? Working capital is often where earnings quality shows up. If receivables are rising faster than sales, customers may be paying slowly, or revenue recognition may be aggressive. If inventory builds, demand may be weakening. Conversely, higher payables can temporarily boost cash but may not be sustainable. I would normalize for seasonality and growth, then assess whether working capital supports operations or creates a funding need that increases reliance on the bank facility. Make sure to cover the operating cycle, receivables, inventory, payables, seasonality, supplier pressure, and whether working capital is a recurring cash drain or a one-time growth investment. Question 7. What red flags would you look for when reviewing a borrower's financial statements? I look for disconnects. Examples include revenue growth without cash collection, margin expansion that conflicts with industry conditions, recurring one-time add-backs, rising debt with flat EBITDA, covenant amendments, delayed financials, auditor changes, or heavy related party transactions. None of these automatically means default risk, but they require explanation. In a credit memo, I would clearly separate facts, management's explanation, and my own risk view so approval officers can judge the exposure. In your answer, talk about red flags across profitability, liquidity, leverage, cash conversion, audit quality, related party activity, covenant pressure, and management explanations that do not match the numbers. Question 8. How would rising interest rates affect your analysis of a borrower? Higher rates affect credit through both cost and demand. For a floating rate borrower, interest expense rises quickly, reducing coverage and free cash flow. Higher rates can also weaken end market demand, pressure valuations, and make refinancing harder. I would check the debt mix, hedges, maturity wall, and covenant sensitivity. A borrower that looked fine at 5% interest may breach coverage or liquidity thresholds at 8%, especially if margins are also compressing. Be sure to mention floating rate debt, interest coverage, refinancing risk, customer demand, collateral values, hedging, and how higher rates can turn an acceptable credit into a stressed one. Question 9. If a borrower breaches a financial covenant, what steps would you take? A covenant breach is a warning signal, not just a technical event. First, I would understand whether the miss came from temporary timing, accounting noise, or real business weakness. Then I would assess liquidity, near-term payments, collateral, and management's recovery plan. The bank may grant a waiver, amend terms, increase pricing, add reporting, or require paydown. My recommendation would depend on whether repayment capacity remains credible under a revised base case. While answering, focus on diagnosing cause, liquidity implications, lender remedies, waiver or amendment options, tighter reporting, pricing changes, and whether the breach signals temporary volatility or structural deterioration. Question 10. What would you include in a strong credit memo? A strong credit memo tells the story quickly and supports the recommendation with evidence. I would start with the borrower, facility purpose, and requested exposure. Then summarize financial trends, cash flow, leverage, liquidity, and industry outlook. The key is balance. Identify risks, but also show mitigants such as collateral, covenants, sponsor support, or recurring revenue. For Bank of America, I would make the risk-return case consistent with disciplined underwriting and responsible growth. Make sure to cover executive summary, borrower overview, industry analysis, financial performance, projections, key risks and mitigants, facility structure, collateral, covenants, rating rationale, and clear recommendation. Question 11. A borrower has declining revenue but stable EBITDA. How would you analyze that? I would not take stable EBITDA at face value if revenue is falling. I would ask what protected margins, pricing, mix, permanent cost reductions, or cuts to sales, maintenance, and headcount. Some actions preserve cash. Others damage the franchise. I would compare results to peers, review backlog or pipeline, and stress the next few quarters. Declining revenue can eventually pressure EBITDA, liquidity, and covenant headroom, even if the first drop looks controlled. In your answer, talk about whether stability is driven by sustainable cost actions, mix shift, accounting choices, reduced investment, or temporary cuts that may weaken future competitiveness and repayment capacity. Question 12. How do you think about collateral versus cash flow in a lending decision? Cash flow repays the loan. Collateral protects the lender if cash flow fails. I would never rely only on collateral because values can fall, liquidation takes time, and legal claims must be perfected. For receivables, I would analyze eligibility and dilution. For inventory or equipment, I would use conservative advance rates. Collateral matters most in downside analysis, but a credit approved solely on collateral is usually a weaker relationship credit. Be sure to mention that primary repayment should come from operating cash flow, while collateral is a secondary source. Discuss valuation, liquidity, legal perfection, advance rates, and downside recovery. Question 13. What does Bank of America's idea of responsible growth mean for credit underwriting? Responsible growth means growing with the right clients, at the right risk level, and with returns that justify capital usage. In credit, that translates into disciplined underwriting, transparent risk ratings, strong controls, and avoiding deals that look profitable but weaken the portfolio. I would evaluate whether the borrower fits the bank's risk appetite and relationship strategy. It is not about saying no. It is about structuring credit so growth is sustainable through cycles. While answering, focus on client selection, sustainable earnings, risk-adjusted returns, regulatory discipline, conduct, capital usage, and how responsible growth affects underwriting decisions rather than just sales volume. Question 14. How would you assign or support an internal risk rating for a borrower? A risk rating should summarize expected credit risk, not just the latest ratio. I would weigh quantitative factors like leverage, coverage, liquidity, free cash flow, and volatility, plus qualitative items such as market position, management quality, industry cycle, and sponsor or parent support. Collateral affects potential loss severity, but repayment capacity drives default risk. The rating should be defendable versus peers and updated when performance, structure, or outlook materially changes. Make sure to cover probability of default, loss given default, financial metrics, qualitative factors, industry outlook, covenant performance, collateral support, and the need for consistency across comparable borrowers. Question 15. Why do you want to work as a credit analyst at Bank of America? I am interested in Bank of America because credit sits at the center of client relationships and portfolio discipline. The platform offers exposure to high-quality borrowers, broad industries, and rigorous risk standards. I like the mix of accounting, business analysis, and judgment required to recommend a credit view. The responsible growth culture also appeals to me because it rewards sustainable decisions, not just volume. That is exactly the environment where I want to develop. In your answer, talk about Bank of America's scale, client franchise, credit training, risk culture, responsible growth, and your motivation to combine financial analysis with sound judgment and relationship impact. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.